Right, welcome once again to the LCG webinar for today. I'm assuming everyone's had a chance to read the risk warning at this stage, so I'm going to jump us through to the title of today's webinar, which is how to trade pound dollar, or how to trade cable, or how to trade sterling. It goes under a few names, but essentially it's the British pound against the US dollar exchange rate, and we're going to talk a little bit more about that right now. So the topics covered today are just a little bit about the currency pair, why, how it works, why it's popular, a little bit about the history of it, nothing too in depth, but give you a bit of a feel for things. What causes the pound price change to the British pound against the dollar price to change, the top economic releases. For those of you familiar with forex trading, you'll know that these currencies are mostly reacting to changes in the economy. So, and the relative changes in the economy between these two, between the two countries of those currencies involved in the forex pair. So we'll talk a bit about that. Specifically, when you're talking about the pound as we sit right now, Brexit very much a ongoing theme, and I suspect at this stage of the as I'm recording this, we're still in the kind of negotiation stage, but I think whether Brexit gets completely cancelled or whether it would drop out without a deal, or whether things go smoothly, I think it's probably still going to be a factor for the foreseeable future. So I'm hoping this doesn't date this webinar too much. A little bit of chat on the technicals, but to be honest, that never is too specific to the actual market you're trading. And then we'll have a look at the pound dollar on the LCG trader platform, just so you can actually get a feel for how to actually get on there and find the information you need and place a trade. So what is it? GBP obviously stands for the Great British Pound. The USD is the US dollar, United States dollar. So in essence, what you're looking at is how many dollars you get for a pound. So if you look at that exchange rate and you imagine it saying GBP USD, the GBP is 1. And so the amount it's equaling, say for example right now, it's 1.3. You're saying that £1 is equal to 1.3 US dollars. And obviously what you're doing by trading it is making a bet that that pound is going to be worth more dollars in the future or worth less dollars in the future. So you're going long or short the pound, and obviously at this, while you're going long the pound, you're in essence going short the dollar, and vice versa. Known as cable, that's just a historical thing after the physical cable that was actually laid down through the Atlantic to help communications between the UK and the US. It's thanks to that cable and the sort of technology that it's the embracement of technology that involved at the time is why it was the most popular foreign exchange transaction. But since then, obviously, we've got the euro, and that covers the entire trading block for Europe. So these days, the euro is the most widely traded currency. Obviously, Japan risen to prominence since then as well. So dollar yen tends to get a bit more trading volume, but the pound is right up there. And yeah, part of it is historical reasons. I mean, the dollar is the world reserve currency today. So hence the dollar is involved in, 95+% of forex transactions, and the British pound, it basically took over from the British pound, which obviously fell from grace at the time of the fall of the British Empire. So why is it popular? Well, you can see that concrete jungle right there is the City of London, and part of the reason it is still relevant, still popular today, is because of London's role as an economic and trading hub. Not sure how up to date this stat is, but it's still about right, is that 40% of forex trading volume goes through London. So London's still massively important for the forex market. I think it might be a bit less than that these days, but it's above 30%, I'm pretty sure. Tends to make big moves on the London Open, known as the cable morning trade. or a few different other names as well. But in general, the pound can be quite explosive, particularly for breakouts. So whereas you might say the euros may be a little bit smoother because of the higher volumes, the pound can tend to move a bit more. And obviously just because, well, at least it used to be worth a lot more than the euro. These days are about on par. You used to get more pip movement for a single economic release, for example. And I think that's still the case, but kind of just less so. You know, it used to be that maybe, you know, some economic data would come out for the US, which obviously would affect euro dollar and pound dollar. Non-farm payrolls, US unemployment, for example, you'd get an 80, 90 pip move in sterling, you'd get a 50, 60 pip move in the euro. These days, as I said, not quite so much the case, because part of that was just in terms of a percentage move. You know, the percentage move of a pound, which is worth more in dollars, is obviously going to mean more pips. So what actually causes the price to change? You know, there are two main, you may recognize this slide from the presentation on the euro, same concept behind it. Two main players in markets, speculators and hedgers. When you're speculating, the aim is to maximize profits by taking advantage of unsustainable currency prices. So one thing you might say about the pound right now is it's very low in a historical basis against the US dollar. You know, 130 right down there at the bottom of the range. As a speculator, you may either rightly or wrongly believe that this is an unsustainable level for the pound. It deserves to be higher within its historical range, and you're going to make a speculative bet, obviously, that the pound is going to rise in value. If you're a hedger, your aim is very different. It's just to minimize the business risk. So it's not really necessarily about the price and where it sits relative to history. It's more about where the price sits relative to the deal you're making in 3 months' time, a year's time, and to hedge off any potential movement in the currency price, which could take place between maybe the date that you sign the deal and the date that you get paid, for example, as a business. But speculators and hedgers both ask the same two questions of speculators, which is in essence us, even as day traders, even as retail traders, you know, we are speculating. Obviously you have some much larger speculators out there, the Ray Dalios of the world, the George Soroses of the world, but still kind of under that speculative banner. But hedgers, they're asking, hedgers and speculators are asking these questions, but as I said, hedgers, they're asking it more to determine whether a hedge is needed or how large of a hedge is needed. You can say you've got a $5 million deal you're doing as a business. Do you need to hedge the risk of that whole 5 million, or could you get away with 2.5 million if you don't see there being much risk of currency movement between the time, again, of you signing the deal and actually getting the product or paying or getting the money back? Speculators, you know, are really trying to fine-tune these questions so they can get the timing of their trades as accurate as possible. The question to ask: are UK interest rates going up or down more than in the United States? And is the United Kingdom becoming a better or worse place to invest versus the United States? So these are two considerations to ask when you're deciding whether to speculate in the pound. We'll obviously get to Brexit in a little bit, but obviously one of the arguments there is that Brexit is making it a less favourable place to invest in the United Kingdom. But obviously it's always relative. On the flip side, you could say the policies of Donald Trump as president is making the US a less investable place. But obviously there's always subject to opinion. You know, there tax cuts have taken place in the US, maybe making it a more business-friendly environment. So you would say that would make it a better place to invest. So these are the kind of opinions you have to hold when you're making longer-term bets, I suppose, on the currency. But even in the short term, obviously, when you hear different news events coming out, news of tariffs between countries, or even political upset, that's giving a short-term, those short-term gyrations in the environment are still reflected in the price. So how do you answer these? I've sort of alluded to it a little bit already, but are the economic and political developments in the UK making it A, more likely interest rates will change more than the US, and or making them more or less favourable to invest in the US? So there's various ways of answering that, economic data being one, but obviously the political landscape being another. Yeah, MK saying the Dow has risen considerably since Trump came to power. Yep, that is true. So the Dow has risen considerably. So has the US dollar risen considerably. So two arguments in favour of the policy. So, okay. Although obviously the US dollar is the world reserve currency, and it's arguably the more important thing to watch in this currency pair. I don't want to talk about the US dollar in every single webinar. So obviously, when you're talking about the pound dollar, let's have a little chat about the UK economic releases. So where to focus? Focus on the most market-moving data releases. If you're trading the news, most news doesn't make a material effect on the market. So you've got to focus on the big ones, and you've got to have an understanding of how the UK economy works. So, for example, don't put a lot of emphasis on manufacturing data because the UK is very service-based. That's why London dominates the UK economy these days, because it's actually financial services is a large part of the GDP versus maybe back in the day when it was the export of raw materials or obviously manufactured goods such like. And the other thing to note about the UK is, even though it is thought of as being one of the most stable countries in the world, obviously one of the longest histories of democracy, keeping in mind I'm British here, so it's slightly biased on this topic, but still that is a general sense, I think. But it does have a very high debt to GDP ratio, so that inherently makes a country a little bit less stable, obviously, when you've got more debt to pay off. So you need to kind of prove yourself as a good debtor. So same thing as if you're taking out a mortgage and the bank says, how do you budget your money if I'm going to give you this big loan for the house? Well, you don't say that, oh yeah, I'm splashing out on holidays left and right. You say, oh, I'm being very frugal with my money and, making sure I don't spend too much. So one of the reasons why, and I'll get into this a little bit later when we're talking about Brexit, but why sometimes a Labour government or the prospect of a Labour government is thought of as bad for the pound is because, typically they loosen up the purse strings a bit, more public spending, and so that's very sensitive to markets, primarily because of this idea that we've already got a very high debt level here. But the general idea, the main idea, you can say I've written here, is anything that could affect investor confidence in keeping their money in the pound is important. So why, again, kind of harping back to the same idea, two reasons for holding the pound: to earn interest and to have investments in the UK. So obviously if you're buying a house in the UK or buying a UK business, you need pounds to buy that. Hence you're creating a demand for pounds, which would in a small way at least, push the currency price higher. And obviously to earn interest. So if you see interest rates in the UK going higher, then you would need to have your money in pounds to take advantage of those future higher interest rates to earn that interest. Quick one on the most important data releases. So for the UK, obviously the central bank is the Bank of England. They have a monetary policy meeting, for the moment at least, it's 8 times a year. where they set interest rates, and particularly since the 2008 financial crisis, it's not been so much interest rates, but it's more been about forward guidance, about what they say, about what they'll do in the future, and also about quantitative easing, which is them buying assets like government bonds and mortgage bonds, etc. And for that reason, because interest rates haven't been changing as much as maybe they did in the past, markets are a bit more fine-tuned to the Monetary Policy Committee, or the MPC for short. They're the people who set interest rates at the Bank of England. So obviously the Bank of England is a big institution with lots of people working there. It's that particular group of people, the MPC, where I believe there's 11 members at the moment. What they say about future interest rates can certainly move the price. Then you've got the extra economic data itself, so CPI and RPI, so that's consumer price inflation and retail price inflation, both closely watched. UK GDP, which is the economic growth of the economy, and UK unemployment. So all these factors going into, again, is the economy doing well? That makes it a good place to invest. People are going to put their money into pounds. Also, if the economy is doing well, at some point in time it might do so well that the central bank feels it needs to kind of take some of the stop it from overheating, and so they'll do that by raising interest rates, and obviously that would mean you'd get more interest on your money if you have pounds. So hence good growth, good inflation, or high growth, high inflation is good for the currency involved. So in this case, for the UK, it's good for the pound. And the services and manufacturing PMI is increasingly widely watched in the markets, just because they're not hard data, so there's no proof, but they are early, because you can just ask the purchasing managers what they think is going on in their business, and get a bit of a kind of feeling for what's coming ahead. Quick question from Roland saying, does China affect these currencies? Well, it does in so factors. Obviously, the big topic at the moment is trade, and both the UK and the US trying to increase the amount they can export to China, and so increasingly China becoming more of a consumer than a producer, and as that transition occurs from China being the supplier of the world's kind of cheaper goods to more of a consumer of maybe higher end products, then obviously you want, as a UK, you want to have a good relationship with China to be able to sell those goods and services, particularly in the case of the UK. So from that sense, you want China to do well. In terms of total value of trade, the US does more, but so you could argue what's happening in China probably, if net affects the US more, but on a sort of relative basis, UK. So day-to-day trading, I couldn't say that that's a massive factor. And then just what can the government do to reduce the debt? Well, I mean, you start getting into politics a little bit, but obviously, for the most part, you need to cut spending and increase revenues, right? So there's debate about how best to do that. You could say that cutting taxes spurs economic growth and will mean that government gets more money, or you could say that cutting taxes will just mean they get less money. So that sort of depends on your political divide. And talking in politics, don't know if you're familiar with these three gentlemen, but certainly pretty central in Brexit. Just thought I'd play that in there. It's quite a funny picture. Obviously, Boris Johnson, David Cameron, and Nigel Farage. Three central figures in how Brexit came about. So general idea with Brexit is that, and this is a good general concept to keep in mind, is that markets like the status quo, they dislike uncertainty. So while certainly, obviously, many people have very strong opinions about what Brexit will do to the UK economy in the long run, ultimately no one really knows. So what markets are reacting to more is the uncertainty of it. Obviously, the UK has been part of the European Union for 30 odd years, so it's quite a disruption. So whether you believe it's a short-term disruption for a long-term good, or whether you think it's a permanent disruption for the permanent worse of the country, either way, there's obviously that disruption in the kind of time period that markets deal with. And you can see pretty clearly here from this Bloomberg chart, the hours preceding and after the Brexit vote, it's pretty catastrophic, from 150 down to 135, falling 15 big handles in a few hours is absolutely dramatic from a currency standpoint. So I put on the right hand side here general rules for trading Brexit. MK saying, just asking about before I get into the rules for trading Brexit, talking about the time for trading the pound. I don't think I did specifically talk about time of day, but what I was saying was that at the London Open, which is sort of 7 a.m. London time, GMT, or British Summer Time, 7 a.m. to 8 a.m. is where you get some kind of big dramatic price moves. One of the reasons that people suggest this happens or can happen is that there's not as much trading for the most part in the pound dollar in the afternoon US session. It's more focused on some of the other currency pairs, particularly the euro dollar. So pound, definitely its volatility tends to be concentrated in the morning of the UK and the afternoon as the US kicks off. Not so much in the US afternoon, not so much in Asia, and so in a way it's got a little bit of catching up to do, so it kind of jumps out of the gates, if you like, when things start on the London Open. Hope that makes sense. But if you don't believe me, obviously, like everything, have a look back through your price chart. You can obviously draw vertical lines or even get indicators for charts that show the time zones, so the Europe, US and Asian time zones, and just have a look back for a few days, for a few weeks. Spend all it takes is 10 minutes to get a little flavor for the hours of the day when there tends to be big moves in the currency, and you soon get a good flavor for, if you are day trading on a short-term basis, what if you're deciding on placing a trade, A, is the price set up there, B, is it a typically good time of day for trading it, or is this going to end up being a false move or a correct move? Switching gears back to Brexit, I mean, it's keeping it super simple here. A soft Brexit, meaning a very close relationship to the EU, or just an outright cancel Brexit if everyone gives up on the idea, and very much pound positive. A hard Brexit where we distance ourselves from the UK, from the EU as much as possible, with really no relationship as it was once when we were part of the EU, or in fact just a no-deal Brexit where, that's it, we fall out, we're completely apart from them, and the UK and the EU are completely separate, and there's no deal in place to integrate the two. Those were both pretty pound negative. But I put a little caveat in here, but a Labour government is generally pound negative too, so it's a bit of a kind of fine balance. Do you, when you see, for example, as I speak, Theresa May as Prime Minister, if Theresa May is the Conservative Party leader and she's fighting for example, say at the moment she actually isn't, but say, for example, she is fighting for a kind of harder line Brexit, then you don't want her to, from the perspective of trading the pound, you don't want to see her succeed with a hard Brexit, but equally you don't want her to do so badly that actually it throws it into a leadership crisis, and that increases the chance of, as I speak, Jeremy Corbyn as the Labour leader getting in. So you've got to play off those two little features. You don't really like Brexit, but you also don't like a Labour government as a sterling trader. Or you know, if you're going long sterling, that is. Obviously, you can go short and love it. So just switching gears to the technicals, you know, keeping it mega simple here. My general take with, you know, one of the joys of technical analysis is that really you can employ these indicators on any market. You might argue that some indicators work better for certain markets. I'm not a big advocate of that idea, to be honest. I tend to think that they all work in different ways. You know, maybe on some currency pairs you'll get more winners, but they'll be smaller. Maybe on other currency pairs you'll get fewer winners, but they'll be bigger. There's that kind of change, but overall, this is a good guideline for indicators to watch. And you know, when people say, "Oh, what's a good market to trade?" Well, for me, I like trading trends because at least the direction that you're trading in is very much covered, and you're just trying to time your trade in one direction or the other. So trends make, for me, life a bit more straightforward in trading. So I prefer a trending environment. So for me, a market that is trending is good. Now I'll show you the pound as it stands in the platform in just a minute, and you'll see that it's been through both those environments recently. So let's just have a look at the LCG Trader platform. I'll bring that up now. So there she blows, and so this is the GBPUSD up here. It's the D1, so daily chart. So each one of these lumps here represents the open, low and close of one day of price change for the currency pair over time. So you can see this chart spans back basically from the start of 2018 to July as we stand. And you know, it doesn't particularly matter if you're watching this at a later date about the timing, but just giving you a feeling for the length of the chart here. You can see that basically the pound went from, or the cable rate went from a nice trending environment. So you could say here the price was above the moving averages. It was trending nicely, and then you can say, so you can say that, you know, this was a nice, that was not quite what I had in mind. During this period, you know, obviously we were trending. Then we kind of came down, and you know, this little move to the downside didn't really go anywhere. We moved to more of a range trading environment here, and then obviously more recently we've fallen back through those lows, through the moving averages, and we've been back in more of a sort of a downtrending environment more recently, with a sharp initial drop and then a more steady decline of late. So, you know, was the pound a good market to trade here? Probably not. Was it a good market over the last 3 or so months? I would say yes, it was. Let's jump a little bit more into the details of the chart. Oh, the moving averages, by the way, are the 20 period and the 50 period moving average. And then these little dots are fractals, just to give you a little sense as to the recent swings in the market. But you can find under forex, under our watch list here on the left, you can see all the major currency pairs, and there's the pound. You can see it gives you a little summary if you hover over it, giving you kind of key details on the market. So you can trade these tiny little tenths of a pip and still make profits and losses on the price movements of those tiny moves. You can see that you can trade depending on the account type that you have, you can trade different account sizes, and there's you know, if you're using a guaranteed stop loss, you know, it needs to be 25 points away, and then you'll get charged 3 points for having that guaranteed stop loss in place. If you're going long the pound right now, because interest rates are higher in the US, you're going to pay 0.85 of a pip for holding this trade overnight. If you're short, i.e. you're selling pounds and you're buying dollars which have the higher interest rate, then you're actually making 0.328. Depends on your account setup quite specifically what those numbers are, but you're making that overnight. And then if you want a bit more detail, obviously this is the area that you can actually place a trade. So to give you a little feeling for the spread, obviously there's always two prices, the buy price and the sell price. So your cost of doing business is the difference between the buy and the sell price, and that's how the broker makes its money, is that little spread difference in between. And you can say in this instance that there's a price of 59 versus a price of 60. The spread in the middle of those two is roughly 1 pip or a little bit less. And then if you want a bit more information on the currency pair there, you can see that it's the I for information, and just a bit of an expanded version of that those details that we saw when you hovered over. So you can see the market hours. It's basically a 24-hour market, 5 days a week, but worth knowing that it does open at 9 on a Sunday GMT and closes around 10 on Friday GMT. So, that's probably about all I'm going to cover at this stage in time without going into too much depth and without whittling everyone's lunchtime away. I hope that was useful. Do get in contact if you want a bit more information on the best ways to get started with all this. Customer services at lcg.com. Certainly happy to help. Brilliant. Thank you very much, everyone. Good luck with trading for the rest of the week. Jasper signing out. Cheers, guys.